If you're a keen investor and invested a good set of your portfolio in the stock markets, I'm sure the last 3-4 days have not been very comfortable, especially if you have invested in stocks that are in sectors like banking and metals. You would be a little uncomfortable and start worrying a bit. I'm an investment manager for close to 2 decades and I manage tons of wealth for HNIs. I've come to understand one important thing, that is, just like the way I go and explain a reason or set of reasons why we should invest into a certain asset class. The asset class can be equity, commodity, currency, or debt. On the back of my mind, I always know the reason why that very same asset class can come down to or can correct to. Just for an example, if I come to you and explain and tell you why we should invest into a GSEC fund because of so and so reason, I always need to create a backup plan if things don't work as per my understanding. You know why this is important? Because if you know your downside, you can run your upside or create larger upsides because the downside is very well known and mentally you are prepared for it. So the last 3-4 days especially have been good to understand why the markets can come down. In our opinion, there are three main reasons because of which the markets can come down any point in time. And I explained those three reasons in this video. Please do watch till the end. The first important reason could be increase in interest rates. I'm sure you all know that all the central bankers across the globe have been extremely accommodative when it comes to interest rates. Be it Bank of Japan or ECB or Fed or our own RBI has been very accommodative on the interest rates front because they wanted to either create consumption or demand or continue the demand that they have created, thereby creating better economic situation. I'm sure at some point in time, the RBI governor or the Fed chief will have to sit across the table and decide, should I go for growth, should I control inflation, or should I take the mid path? See, many of you know the very famous DCF model to value a company. Today, the interest rate being low means that you value a company at a higher multiple. But tomorrow, when the interest rate goes up, you may have to value the same company at a slightly lower P multiple. The second reason for correction could also be that higher interest rate would mean that good set of money that is flowing into the equity markets today will actually start flowing into the debt market too, thereby creating a bit of price correction. So therefore, keep a very close eye on 10-year GSEC rate of India, which is 6.1 plus at this point in time. The second reason could be, and it's a very fundamental reason, that the companies that you're investing in have started executing well or executing their plans poorly. See, everybody today gives a certain PE multiple to a stock based on the growth expectation. And until unless the company surprises you on the growth multiple, your growth rate may not be really high because you've already paid the price for the growth. Therefore, if the company does very well, today if you see IT companies for that matter have been doing extremely well and therefore they continue to rise up and up. But on the other hand, if you start seeing that the bank or the company that you're investing in has started poorly executing its plans, it means there can be a price correction in that stock or the country on a whole, because if the economy doesn't do well, the companies also will not do very well. This is one of the reasons why the markets can come down in the next few months, few quarters, few years, you never know. But please keep a close eye on economic growth and the portfolio companies' growth too. And yes, Finally, the most talked about subject, inflation. We all know, or if you don't know, please know that RBI is mandated to control inflation in a certain band range. And if it is not able to do so, it may hike up the interest rate like I was mentioning earlier. So therefore, if they have to take a call between inflation and growth, that's not a good situation to be in. The best thing to happen is inflation being below 6 and growth rate being as high as it should be. Now, what is the problem with inflation? In India, there was supply side constraint because of which a lot of food inflation did occur. But with COVID lockdown coming down and transportation becoming better, that has been more or less taken care of. But the problem that we have is that we import a lot of inflation, especially via commodities like crude oil or metals. We import a lot of them, thereby not being able to control that particular inflation. And if that continues, it would mean that we will have higher current account deficit, thereby leading to INR depreciating. So therefore, we need to control inflation as much as possible domestically and see that the interest rates don't go up to control inflation. Please keep a very, very close eye on CPI and WPI so that you know if it starts going up, the prices of the Indian stock markets can actually come down. I really hope you like this video. Please do share your feedback. Good day and happy investing.